Good morning.
Good morning.
I tried to find another song, guys, to kind of change it, the pace, but
Yeah.
I did not. It was just too slow, the songs that were quite available. So, we want to start our day with a lot of fresh energy, and the only way to get that is with some really rock music, at least to
Yeah.
me.
Yeah. Yeah. That's a good one.
All right, good morning, guys. Welcome to the show, Coffee Time with Marie Torossian, CPA. If you are returning to this show, welcome back. If you're new, give us a thumbs up in the chat so we know you are new. Go ahead and please subscribe, like the channel, the page that you're watching us on. We are going live every Thursday at 10 a.m. on Facebook, on LinkedIn, and on YouTube. I am your host, Marie Torossian. I'm a certified public accountant, CFO, and auditor, and a chartered gold management accountant. And recently, I do have to share this, so I'm so excited. I got certified as a 10X coach, a business coach, and I am so excited about this. And I am so excited to help so many individuals. Including people in our own CPAs that are wanting to change the way they're doing work. I want to just go ahead and introduce my friend and my tax colleague, Pedro Gonzalez. Pedro, good morning.
Good morning, Marie. Good morning, everybody. And it is a good day. Uh, so, Pedro Gonzalez, your business and tax strategist, helping our clients with tax minimization strategies, improving your cash flow, and with exit strategies. Like I say, all of us are going to exit. It does depend on how. Exactly.
That's it. That's it. And then Pedro, I did want to have I did want to do a quick announcement. That's why I kind of shortened some of the intro part right now, and I can put in the banners and all that. But today marks a whole year of us committing to
I know.
this.
I know.
Episode 52. We've been
Yes.
committed 52 weeks straight to
Yes.
do this.
Yep.
So happy 1 year anniversary to us.
Happy
On
anniversary,
Coffee Time.
Marie.
This is
Happy
so exciting.
anniversary. Yes.
So we really want to hear from our viewers and our listeners because we're always trying to bring a lot of interesting conversations here that nobody's talking about. There's not a lot of other CPAs and accounts that are talking about these specific issues and how it relates to business owners. So we are here for you. We want to answer more questions. So please send us your questions. Send us your questions. You can send it to me directly, Marie at marietorossiancpa.com. You can also send it to Pedro if you like. Pedro, you want to say your email, the best way to reach
Yeah,
out to
sure.
you?
Pedro at pedrocpa.com. Very easy.
Very easy. It's basically our name and last name, CPA.com.
Yep.
So we want to answer more of your questions so we can maybe celebrate the second year, right? So we will try to come up with subjects that we believe that it's going to help you out. But hearing from you, it's different because you are the ones going through these difficulties and challenges, and we want to be here for you and answer your questions. So with that, I want to do a quick summary of what we talked about in the past the past year. I can say that.
Yes.
The past year, all of last year, we've talked about so many different situations and issues that have come across us as CPAs. We've talked about investor visa and business, projections that goes with the application. We've talked about IRS versus financial audit. We've talked about inventory management. We've talked about a whole tax planning series. We've talked about real estate business and how to do it, how to make your business recession proof. We've talked about, more business related things where we talked about mindset, how to keep motivated, and very strategic business related issues. We've talked about factoring receivables. This is stuff that most small businesses don't even understand how to handle it. We've talked about capital gains, messy books. We've talked about so many things. And last week we actually covered a franchise or license purchasing, right? So, and how to handle that. And today, because we come across yet another problem that a lot of small business owners are going through, and with so many changes coming down the pipeline through the IRS and more auditors being hired, and then there's going to be a lot more scrutiny on how the books are being handled and how they're being reported on the tax returns. we've come across an issue where, shareholder, if it's an S corporation, or a member, if it's an LLC, and how the members or the shareholders' capitals are being handled. There's been a mismatch, too much distribution, no backup as to how they started, what they put in, the initial investment versus the distribution. So we want to talk about this today. And of course, Pedro, you've had such experience in this area. And I'm gonna, as my guest, please start us through this conversation. Where do we start?
Where do we start? That's a good.
That's always the key point, right?
Exactly. Exactly.
Where do we start?
Exactly. We start in the beginning.
In the beginning.
Well, no, but really the issue of this is a good topic. I know we covered briefly in one of the previous episodes about the trying to bring awareness of the fact that the IRS is going to be paying more attention to this capital accounts, something that has been overlooked by many years. Probably some people noticed that there's a new schedule that needs to be attached to the 1120s to, in essence, disclose now the roll forward of your basis, something that was not done specifically in the past. I mean, it was, it could be, you could kind of work backward, but now it's going to be included in the tax return. It's a schedule that you have to attach. And so it kind of indicates what are the intentions of the IRS. We talked about this in the past. It's something that needs to be addressed. And I would encourage the listeners and the viewers is to meet with your tax preparers and make sure if you have any kind of pass-through entities, not only S corporations, but also LLCs, partnerships, to make sure that topic of basis is properly accounted for. So I know that you and I have this conversation. It's an interesting conversation because what happens is that people are handling this, as long as there's money in the bank account, what happens is in a way it happens is because they're treating the corporate account as almost like their extension of their personal account. So in that process, as long as there's money in the bank account, the shareholder or shareholders, let's use an S corporation for this example, what is happening is that they're just simply, there's money there, so pay my car, pay this and pay that.
Right.
And so in that process, there's not a true accounting. They realize that potentially after the fact, that in reality, you didn't have the basis for this distribution. Now, what happens is if you do these distributions in excess of basis, then is taxable dividends. This is the part that gets omitted. And this is what the IRS is going to go back and start auditing, is that you should have, it's not so much about, well, you cannot distribute. I mean, the company has the money, and you don't have the basis. Well, you distributed yourself in excess of basis, then that is taxable income.
Understood.
And so that's what you're supposed to do. I took this money, it's in excess, so I'm going to report it on my tax return as taxable dividends. But what is happening is that, it's an ongoing process. Money's coming out, and nobody's really focusing on this and saying, okay, hold on, Mr. Smith, you have to stop, or be aware that this is going to now be.
Right. And I think, and I'm wondering here, and because why wouldn't a business owner, instead of just taking out distributions for themselves, just increase their salary and just simplify this basis calculation? And because it does take a lot of internal effort to track the basis or the capital. Basis is more the word on the tax side, and then on the GAAP side we use more of the word capital, the capital bank account for the shareholder. So it's a lot of work, and a lot of times these small business owners, they don't have anyone specifically tracking or creating a spreadsheet to track all of this. Why can't they just increase their salaries and then just pay their personal stuff like that? Would you recommend them do that?
Well, the ideal situation is that they keep their lives separate. Yes, I mean what they should be doing is setting up a salary and then setting up a specific draws and instead of having the company pay directly the expenses of the owner. You know what I mean? So
Right,
more
right, right,
systematic process where you have a salary of X, and then every either month or every quarter, whatever the process is, you're going to gain a distribution based on a percentage of the profits of the corporation, and an allocation of basis, based on the allocation and being distributed. That's the ideal situation, is what is recommended.
right,
But again, one is what is the theory, and the other the practice. I mean, what is happening is this other process, which causes a lot of headaches and a lot of, and also we mentioned this in another of our episodes in the past, is that the risk of exposing information that shouldn't have been exposed in an eventuality of an audit. If your S corporation
right,
is being audited, now they're going to see all these other transactions that are directly reflected on the books of the corporation that shouldn't have been there. If
right,
you simply
right,
pay yourself a salary, and let's say every month Marie gets I don't know, a some X distribution, you know what I mean, that goes to her personal,
right,
and that's the end of the story. There's nothing else in there other than she gets this X amount of distribution, and she has a W-2. That's it.
right.
That's what is recommended. Yes.
Yeah, and perhaps also as maybe a recommendation could be that if they don't have to do the draws, if they don't need the extra drawing every month, is just to kind of think about it at the end of the year, what is the anticipated profit, and be able to take the draw at that point in time. Just to simplify, what's the maximum that they can take. Okay. So my next question, and again, because I want to lead to the way a business owner might be thinking right now, is that, so if they have taken out more draws, and what is it? What can they do to correct this situation?
Mm-hmm.
What is the best way to correct the situation before they file their taxes? Say.
Yeah. Before I address that, I don't think I answered one of the questions you asked previously, is the why not increase your salary.
Right.
Now, the reason I know why it's not done is because of payroll taxes. And so they're trying to avoid paying payroll taxes because they're not paying payroll taxes on the distributions.
Right.
This is what the IRS doesn't like, is that you're taking all this money out. And this is another, and I know we discussed this previously, which is a reasonable compensation.
Right. Yes.
I'm not going to go into the details of that right now. And if you have any questions, they can reach out and then evaluate if you have reasonable compensation, which is another topic. And this is another area that the IRS is going to be looking at. One is distribution. Number two, reasonable compensation. Those are already two topics that the IRS said that they're going to be looking at.
Right.
But again, to answer your question, the why, because they don't want to pay the payroll tax. Because yes, as you increase your salary, you're going to be paying payroll tax. But there's a way to calculate this to at least establish what we call reasonable compensation. And the reason we recommend it is to mitigate a little bit the risk of audits,
Yes.
Exposure of unnecessary disclosure of information. When you see a lot of these transactions, little transactions going out of your Walmart, CVS, the liquor store, and
I know. Oh my God.
like, you don't want to be disclosing that. I mean, you don't want to disclose your personal expenses and where you go to buy whatever. I mean, this is my personal
Yes.
life. So keep that in mind. Now, going back, how do we correct this? Well, if the ideal situation again is that this gets monitored on a regular basis. But let's assume that now here we are approaching October, and you realize, okay, your client now has this negative or a deficit, or approaching that deficit. So
Right.
is one of the options could be to reclassify some of those excess into a receivable.
Receivable for the company. Yes.
But then establish a true receivable from the company, meaning that you explain to the taxpayer that we're going to create this receivable. There should be a document, there should
Right.
be interest, and a repayment plan.
Of course.
So
Of course.
that's one way, or for the owner to put the money back into either the member or the shareholder, put the money back
Right.
into the company
Right.
to restore that deficit.
Right. So that the basis comes back to what it should be. Yeah.
And I like to use the way I simplify for a lot of these shareholders and members. They got to look at it as a kind of a bank account. You know what I mean? So, you have a certain funds and it gets increased by the profits of the corporation. It gets also increased by any contributions that you have made in addition to your initial contribution, and it gets decreased by the losses of the company,
Right.
and it gets decreased by the distribution. So simple formula
Yes.
that that's how you keep track of this account. So if you by any chance you're distributing yourself more, then you created a deficit, and you have to now you in essence you owe that money, or you have to pay tax on it.
Right, right, absolutely. And in a situation that arose, and I want to make sure that our listeners and our viewers are paying attention to, is that we came across a situation where over a number of years, the shareholder kept on taking out money, distributing to himself additional money, even though his basis was already negative.
Hmm?
So, and you had mentioned something to me that should have been done, or what should have been done versus what was done. So would you mind kind of walking us through that situation and then advising our listeners and viewers what they should be doing?
Well, I'm trying to I'm trying to I'm trying to see how can I explain it without
In a
disclosing,
simplified manner.
and also in a simplified manner. Yes, because it was a little convoluted, but I'm trying to the scenario that you and I discussed is in this situation there was excess distributions. Now,
Right.
what should have been done is what we just mentioned a couple minutes ago, is that what you should do is keep track of this on an ongoing basis,
Hmm.
in order to determine once you're reaching that point. Like for example, right now, that's what we're doing with some of our own clients, is that let's look at your capital accounts as
Right.
part of the business planning and tax planning, is looking at that, because it does have a tax implication. So we're looking at that. That's what should be done on a regular basis, an annual basis, before we're reaching out the end of the year, is analyzing that account and see where you at that moment. Uh, Now, in the case in question, the individual, I think at the end, has some years that had some excess.
Right.
Now, again, this is an issue that has to be evaluated, because if what the IRS could do is say, well, you're supposed to have paid taxes on those years that you had the excess, and that's a risk. I mean, how do you correct it now? Uh, because the thing is, it's already disclosed on the tax return. You know what I mean? That's the issue. You know what I mean? That how do
Yes.
you correct it? You'll have to either amend it, but amending is just waving a flag. That's why it's important to address it on an annual basis.
Right. Right.
Because if you're right now discover, okay, or that your client's approaching that point where you listen, any dollar from here forward is gonna push you into a deficit.
Right.
So then you avoid it, or you make an adjustment before you close the books, and before it gets disclosed on the
On
K1,
the
because it gets
taxes. Right.
disclosed on the tax return. All the IRS has to do is add up all the distribution that you did over the, let's say, 5 years, and they're gonna see, okay, you have distributed yourself X sum. You know what I mean? That they this is what you told us, that you distributed yourself. So there's not a whole lot you can do about the past. You cannot call it now a receivable.
Yeah. At this point, you can't really.
Yeah, it all of a sudden pops up on your books, and you do a reclass. I guess you could. I mean, I'm not saying you, but it's gonna look bizarre. But that could be a remedy at the last minute, the last resort. There's nothing else. I would say probably if it was my case, I would probably look at that as a one option before amending.
Mm.
It's a probably reclassify, make sure that the shareholder signs off on this, and start making payments, at least to show the intention, and
Of course.
that I intend to put this money back into the company. There's interest, and I'm going to be paying these dollars back.
Yeah. Yeah. Absolutely. Absolutely. So the interesting thing was, and this is, we're trying to build it out, guys, because the situation we encounter is a lot worse. So we're building up the information slowly for you guys. Like what should have been, what is the right thing to do, then what happens if you make this mistake, and then the next mistake. So now in this very unique situation, it was like mind blowing for me, super complicated, because what we noticed is that there was at least about 5 years of distributions, but then the reporting on the tax returns were way off. So now fixing this was just to come up with the calculation of what it should have been versus what got reported, because the prior accountant did not break it down properly. And then it turned out that based on what was reported, also not all of it was proper distribution. So it was reported X, but the person, the shareholder or the member received Y, which was less than what was reported. So now they paid taxes on stuff that they didn't even get money on. It was just so convoluted. It was like, I don't even know where to start.
Yeah. No, the situation, that's why I was trying to, how to answer that question. What should have been done? They probably should have fired that accountant. But anyways, what should have been done. But it was more complicated than what I explained. I mean, your situation had to do with not only with the issue of excess distribution, but then the accounting. Yeah, I mean, so it's another topic, and I know we have discussed about messy books and all of this. Even though I'm not gonna say this is messy books, but there's like you said, a discrepancy between.
Major.
You know what I mean? You're saying on your books distribution is X, and then on the K1 is something else. So how do you explain that? I have no idea. You know what I mean? So this is something that is bizarre, but I'm telling you, you when you start picking up on new clients and you see this kind of things, I mean, I had to in one case reject a client. I mean, decline because it was I don't want to even touch it. It's not worth it. I mean, it's so messy. The prior accountant cannot be reached. To at least have a conversation between peers. I say, hey, Maria, I see this. Maybe there's an explanation. You know what I mean?
Right.
Okay, Pedro, here's my work papers or whatever. Oh, okay. I mean, I don't agree with you, but I can see how you arrived to this. You know what I mean?
Exactly.
So at least you gain a comfort level to take over this assignment. And what are you going to do? Let's say, for example, you have to make a professional judgment call on this and say, okay, how do I move forward with this? Because remember, once you take over, it becomes now your responsibility. I mean, you're going to be signing off on this return, and the basis has carry over. I mean, you know what I mean? That's the impact. It's not a 1-year transaction where in 2018 they deducted, I don't know, and took over Section 179 and accelerated depreciation, and they shouldn't have. Okay, that's one thing. But there's the issue of basis. Is this is the impact of this year after year, and the accumulated effect of this.
And this is also going to be very key, it's a big key, and I wanted to make a point here, is that if you are considering becoming a partner with someone, you should be asking for this, because if they're not keeping track and they're not doing it properly, and you're now buying into this company, and it's a mess. Now it's also your mess as a
it's a mess. Exactly. No, this is an awesome point that you're bringing up, and this is why I encourage anybody that is in a multi-member S corp or LLC or partnership. This is a serious matter. I mean, you should not take this very lightly, because what we're dealing is your, in essence, your bank account in this venture.
Yeah.
And so you want to make sure that my account is reconciled properly, and my partners is reconciled properly. Like you said, if I'm going to be part of this, I want to make sure that my distributions are in accordance to the operating agreement, and that my balances are correct.
Right.
So, this is again, you have to make sure that whomever's your tax preparer understands the S corporation and partnership accounting. You know what I mean? How to do this?
Break it down.
And it's unfortunate, but some people want, and I'm gonna say it again. I mean, you want cheap bookkeeping. You get what you pay for.
Yeah.
I mean, there's no other way to call it, Marie. I mean, is that the issue is that sometimes people don't want to, and this is a call for also for our profession. I mean, we provide valuable service.
Right.
And we ought not to, to undervalue our services, or to continue condoning, in essence, this type of behavior. I mean, listen, you ought to have professionals to help you here and to prevent unnecessary audits. And God forbid you do get a notice for an audit, that can be handled quickly and promptly. And here's a, boom, boom,
All the
boom. Here's the
support
points.
there. Yeah.
It's done. Again, the IRS agent might not agree with you, but at least the IRS agent will see, okay, I see how you arrive to your numbers. And many times they're willing to at least either compromise or negotiate the adjustments. And
Right.
it's end up quickly because they can see your work product. They can see, okay, this was
Right.
done professionally. I understand how you arrive to your numbers. Your numbers reconcile. You don't see this thing of distribution on your books as X and your K1, K1 is another number. And then there's no reconciliation between the two. You know, it's unfortunate, but this is what is happening. This is what I see that the risk for a lot of medium and small businesses is that it has not been addressed, and then they're going to have a cumulative impact of
Yes.
problems that's going to come and bite them, where.
Yes, yes, absolutely, absolutely. And I really think that I really wanted to bring this subject matter up because it is, we still have, a whole quarter of this year. For those of you who have something messed up, this is a time to really go in and look at what you've done in the past. And if there's any corrections you can make, do it now before the 2022 is closed out and you're ready to do your tax returns. Go back and look at it. Also look at, we talked about this the other day, is the intercompany things that you're doing. You have multiple companies. Make sure any transfers are being done properly. It's documented, and it's not just like random transfers here and there. Nobody can explain. There has to be some kind of an explanation there. So yeah, definitely look at your books. And if you have any questions, make sure to bring it to us and we are more than happy to help you. But something you said, Pedro, is that, in this situation that I've been working on, I mean, if it was me, I would not have taken the job as well. However, we're just assisting another accountant that's has taken this assistance of the client. So we are really trying our best to get the most analysis done to help this client. But yes, you're right. Usually I would not want to take something that's going to come back and, be such a pain in my, what.
Exactly.
I want to minimize my risk because we work very hard to become CPAs. We do want to help everyone. But at the same time, there's also a certain amount of risk that we are taking on behalf of our clients. So we want to make sure we're taking on the right clients. So I liked what you said about for our profession, to really pay attention to what you're doing and what type of clients you're taking on and what kind of risks you're putting yourself in. So a message to business owners and a message to our fellow CPAs.
To our own peers. I mean, because, we are signing on those returns, and I can assure you that, again, God forbid that one of our clients get audited and, things don't go very well, you're going to be the one blamed. They're not going to take responsibility. They're going to say, it's Marie's fault, it's Pedro's fault. He or she told me or whatever. You know what I mean? And we have to protect also ourselves when we have clients are, a little iffy about following our directives or our advice. When it comes to certain decision, listen, I think you need to reclassify this. I think you need to report this on. If you're not going to do this, then you need to report it as taxable income. Well, I don't want to report it. Then you have to make a decision. Exactly. You want to do business with this individual.
Yes.
Now he doesn't want to put it as taxable income. He doesn't want to at least put it as a receivable and make some repayment, pay some interest.
Right.
No, I don't want to do that either.
But we're running out of options here. There's only so much we can do to assist and have them lower their risk. And without, at that point, it's like we have to make a decision as a professional if we want to continue serving this client, because if they cannot follow proper regulations, then we are not going to take the risk of getting in trouble on their behalf. So it's important that our profession respect the work that we do and minimize our risk as well.
Yeah, and it goes along with the compensation and all of that. I think we ought to, what I mean? We do, again, as a profession, we provide a valuable service to our clients. We help them minimize taxes. We help them keep good, clean books. All of that has value to our clients. And I think we ought to then, charge the fee that is reasonable and makes sense. And I know clients are going to be looking for less expensive. If again, you have to then make a decision: do I want to do business with this individual that all he or she cares about is how low can you go, Marie?
Right.
Is that the person you want to do business?
Yeah. And just to give you guys heads up, like something like this, when we have to analyze and go back 5, 6 years to do a cleanup or figure out why things were messed up so much with the prior accountant or you as the business owner, think about the cost could get up to like, 5, 6 thousand, 10,000. We've talked about how much it costs to actually clean up stuff. And when it goes back 5, 6 years, so we're almost doing a mini audit on a specific section of your of your business where you have done some such meshy stuff. We need to clean that out. And so think about it. It's actually better to get it done right the first time. And this is what we always are preaching in a way to business owners: just get it done right the first time. Pay a little bit higher and higher fees to have someone knowledgeable do the work, so that there's no discrepancies 20 years down the road, and now you have to fix 7 years at least and get taxed on things that you misreported. you know so that is the end message that I definitely want to leave with, is that make sure that you are hiring the right people, at the right fees, and then getting done right the first time. So it's less costly that way, really.
It is.
So we are at the 30-minute mark already. I can't believe it. This was a very cool conversation. And of course, I always want to leave. By the way, guys, I just want to kind of say briefly, for those of you listening, and I know I keep forgetting to say this, is that we have a lot of programs on my company page, theprofitlab.biz. You could definitely, we have different programs from like $49 to $2,000-$3,000. But there's a lot of webinars and programs that we have pre-recorded and ready for you to learn. So make sure to go and check out those programs. And of course, as a 10X coach, I'm always available to you to help guide you through your marketing, sales, operations, and finance, and help you grow your business the proper way. And you can get a little bit more information on that, and I'm going to put it up here now, is on the the plans. There we go. And that's going to be the profitlab.biz/plans-pricing. So you'll see a little bit more on that over there. So there's nothing better than knowing what you're doing and doing it with someone who's knowledgeable, right? So that's going to actually protect you a lot more than you trying to figure it out yourself, make some messy stuff, and then we have anyone coming back to clean. It's going to be more costly for you. So just pay attention to that. And and with that, I want to leave you guys with the usual quote that I leave you with from motivational speaker Jim Rohn: "You are the average of the 5 people you spend the most time with." I hope we are 2 of the 5 people you are spending your time with to learn and grow your business. So until the next episode, starting the 2nd year now, have a wonderful and a blessed rest of your week.
Wonderful. Take care.